So I've been waiting to talk to you for a while, man. We've talked about a lot of different trades over the years. I stopped doing my oil trade at the perfect time because the correlation went.
Yes.
Just gone. Like, I don't know what in the world is going on with oil.
No.
But I got out of my last oil trade for a nice profit, so
okay, good.
I feel pretty good about that.
Nice.
But I've kind of stayed away from it. That was
From
been
oil.
It's been my bread and butter for quite some time.
Really?
Yeah.
Long or short?
That was the one. Just long.
Oh, okay.
I'd never short it, but I would sell it, based on when I heard people talking about gas prices being too high or really high. It'd be on the news, gas prices soar. Well, that's when I would sell. And then when people started talking about how cheap it was, I would buy. And sometimes it would
gasoline prices.
Gasoline prices.
But what if there's a strike at the refinery?
It correlated really nicely.
Did it? Okay.
Not anymore.
No.
Not anymore. That correlation is gone. See, a lot of correlations kind of going on, like bonds and stocks. The relationship there seems to be a little bit jumbled. We've made, I don't know when it was, maybe it was October that we had a new all-time record high in the Dow Jones.
Somewhere around there, yep.
Somewhere around there, there was an all-time high.
August, I think.
Yeah, so somewhere in there. There was a new all-time high, then there was another new all-time high.
Yeah.
Almost got to 27,000, which is really nuts. If you think about when we were on the radio, and whenever that was, 2010, 2011, we were at 9,000 a Dow.
Exactly.
So we're talking about a triple. Now with regard, and we'll talk about the politics involved. We'll talk about the things that Trump's done. I want to talk to you about China as well. But just right off the bat, give me your appraisal on Trump as a president, not a person.
Is that not the same thing? No, look, I think it's really tough to say. I mean, he's a little bit tough to gauge because I think ultimately he's trying to do the best thing that he feels is right.
Sure. I think all presidents are.
I think mostly, yep. I think the way he's done business his whole life is to sort of bully people around the place, and he's taken that style and is doing the same in the White House now with these, trade wars and everything else he does. He's just like trying to bully people. And I think he's discovering it's a little bit harder to do as a president. He's now trying to also bully the Fed, right? So he tries to push them around as well, and they're supposed to be independent. So I think that he's trying to do what he feels is right, but I think it's going to have some serious repercussions.
You do?
So, yeah.
Okay. So what is the downside to some of these things, some of these actions?
Well, trade wars is a big one, right? We've already seen a little bit of a rumbling in the stock market the last couple of days because of what he's announced. You're going to have China pushing back. I don't think either economy, the US or the Chinese economy, is really in a position to be able to handle a trade war. I think the global market has sort of fallen apart, and now here we're sort of fighting about something that isn't helping either side.
Gotcha.
So
why do you think the global market has fallen apart? That's a pretty big statement.
Well, just if you look at all the data.
Yeah.
So outside of the US, we're in a sort of a little bubble in the US. Outside of the US, if you look at, Japan, Germany, China, England, France, all of those other major economies, they're all struggling. You've got Germany and Japan and France all roughly at negative interest rates still. This is after all the stimulation.
Negative interest rates?
Yeah, we're going to be there too.
We'll be there?
Yeah.
Negative interest rates?
Negative. Put your 100 grand in the bank and get 99,000 back.
No. There's no way. How?
I don't see how it can't.
What? Yeah. How could that be, though? I mean, why would anyone put their money in the bank if that were the case? How could the bank expect to receive deposits in that situation?
Correct. Well, that's the whole idea, is to stimulate, right? Don't give us your money. Go and invest it.
I see.
So that's the whole idea. But even so, the price of the bonds in the bond markets of Germany and that, there's still I think it is up to 10 trillion now in negative bond yields. Basically betting, if you're going to buy a bond that's earning a negative yield, it means you're expecting the yield to go lower so that the price of the bond goes up, right?
Okay, so you're just trading the bond for
You're trading
value.
it, but that also means there's a lot of money that has to get deployed into these safe style investments. So yeah, negative rates is the ultimate, well, hopefully the ultimate stimulant. But the problem is it's been in Germany and Japan for a long time and it hasn't stimulated.
But you think we're on that path too?
Yeah. Have you looked at the bond yields? Going back like 20, 30 years, we were up at like 14, 15%, then we came down, then we jumped to 8, then we came down, went to 6, came down, went to 3, and I think the next step is further down, because the other side of it, if you take global debt as just a total number, I think it's at 200 trillion now. So if all the governments owe this debt, which we owe, I think, what are we, 23, 24 trillion?
Somewhere in there.
Okay, you add 1% to interest rates, that costs you $200 billion in interest. We're already a $1.5 trillion hole, even though we're in supposedly a boom economy. We haven't got to the meltdown yet, and we're already in a 1 trillion hole. So once you start raising rates, you're going to be 1.5, 2 trillion. Eventually, you lose all credibility.
Dang.
So the only way they can stop it all is to stimulate further, when we roll over, is to lower interest rates from 3, aren't we? 2.5 or 2.49, I think it is, on the 10-year.
But it's interesting because right now you can get CDs for almost 3%. Like
I know.
You can get like a 3-year CD for like 3%, which
Yep.
is, we were discussing. So just go ahead and throw the graph up real quick, Harry. So we're just kind of looking here at the Dow. And Steve and I used to talk on the radio all the time, just kind of about what we were doing and what we were looking at and seeing here. And so I got out of my stock holdings here in August. And it's a difficult thing to try to time the markets. We should say that. It's a very difficult thing to do. But me personally, I felt like I'll take my CD money. I liked the 3%. It looked good to me at this point.
Yeah,
Just didn't like what I was seeing, you know. So I got out and then felt like a dummy for about 3 months. And then it started moving. And then we saw, usually there's the Santa Claus rally.
Right.
It was the Santa Claus sell-off last year, which was really interesting.
The biggest since 1930.
It was huge. It goes from here. So we were at here in the Dow.
Yeah.
The high there was almost 26,000. So almost 26,000 there, all the way down here to below 22,000. We got
Yeah.
to 21,792, Steve.
Well, I think it'll go to 15.
You think 15 is the number?
I'm hoping around 12, 15.
You're hoping. All right, so you're short the market.
Yeah.
Clearly trying to make some money on that. But
Not necessarily. I mean, I've got a lot of positions that would be long in terms of my private equity investments, right? So one of my investments is in Hawaii, and that relies on tourism. If the Dow falls to 12,000, you know, that's going to dry up tourism pretty fast, because everyone's doesn't have a lot of discretionary money to spend around, because that really means the economy's in the tank. So it's not like I want that. I just sort of want to be right. Because if you look at what's driven the market, right, it's cheap money, low interest rates, and recently the whole market's been driven by the SOX.
the socks?
Yeah, the semiconductors.
Okay. You call
They
those the
just
socks?
driving. I mean, if you remember back in 2000, were you born in 2000 or you?
Yes. I'm 38 years
Okay,
old.
so just born.
I was working.
You were just born.
I was working a full-time job in 2000.
Okay,
yes.
well done.
I do remember though the whole tech bubble.
Yeah,
The
driven
internet
by
bubble.
the SOX. You must pull up that SOX market again and you'll see. And the SOX has gone up just, I think it's up like 30 or 40% this year so far.
This year?
Yeah, and it's semiconductors that are driving the whole thing based on no good economic reasons. I
No
mean,
good
Apple
economic
can't sell phones, right? I mean, they
Struggled a little bit. But that was going to happen because the innovation, they took the iPhone so far, so
Yeah.
fast, there was no way to keep up that pace of
No.
innovation.
So you've got them well, the world is saturated with phones, whether it's them or
True.
That's
true.
Where are the other Samsungs or whatever? So the DRAM and the RAM and the NAND and all these tech things that the little chips, the prices of them are down in recessionary levels. The prices have just capitulated. But all of the semiconductor stocks are in orbit.
Why is that?
It's momentum, that's all I can work out. Everyone's expecting a second half recovery, but how can it recover if you've got China and America going at each other's throats? You've got the Chinese economy really slowing down significantly, along with Germany, Japan, and everyone else. Where's the second half recovery coming from?
That's a good question.
From the U.S. consumer?
I haven't heard about the second half recovery, but I will say, look at the chart, pull up the chart one more time. So we got down to that 22,000 level here, as you can see. So it's Nice
And then
move
we had
down.
real madness.
And then this right here really
Yeah.
threw me off, Steve. Now, and typically, and we're not necessarily saying there's going to be a stock market crash or saying anything like that. There could be. There always could be. Steve thinks there will be. I kind of do too, actually. But the point is that, it's just very interesting to see that rally. Whenever there is a crash, there tends to be a move that I call a false confirmation, where you start to see movement go in the other direction, and then all of a sudden, it just rallies back. In other words, anyone who was right, who thought they were right and shorted, in this move here somewhere, they all got run out.
Yeah.
And the people who were naysaying but stayed out, or the people who were like, no, buy more, they were right. And so what it does is it sort of cleans up. It cleans up a lot of the people who are negative. It eats the bears up a little bit and gives the bulls even more confidence that the next dip, I'm going to really load up, because this last time I only did a little bit, but next time I'm going to really load up. And that next one is the one that's the problem.
Well, what happened with the Uber IPO?
I don't know. What did happen with it?
Well, they were supposed to come out at like 48, 49. I think they came out at 45, and last I checked it was in the 30s.
Wow.
Yeah.
Yeesh, Maria.
Okay, so then you look at the IPOs. If you want any kind of correlation in a market at all that I've looked at, it's around about the 2000 frame, as you were mentioning. Yeah, even you remember the whole bull market running with tech, right? Back in 2000, it was insanity because everyone coming to market with IPOs wasn't making any money. I don't know if you remember that. They all listed themselves, and no one was making any money. They were all losing money.
Oh, you mean the companies?
Companies.
Yeah, they made money by doing the IPOs, though.
Well, they got money in the door, but the company was bleeding money, right? So it was like, why are these people buying these ridiculous stocks when they're all losing money? Okay, and then the market rolled over and died. In 2000, 80% of all IPOs were losing money. 80%.
Wow.
That's insanity, isn't it? Okay. This last year, 83% of IPOs were losing money. And this time, not just a little bit of money. I mean, this year I think we've got WeWork coming to market. They only lost $2 billion last year. So that's worth a $40 billion market cap. I mean, seriously, that means my little fudge shop should be worth about $28 trillion. I mean, and then you've got the other thing is, because you put it into perspective. So one of my little companies in Hawaii, it's Hawaii Fudge Company, and we do, roughly about $1 million, $1.5 million in revenues. Okay, if I was Facebook, I would be able to sell myself for $15 million.
So how are they able to pull that off?
That's what I'm saying. How can the stock market keep going up? It's all momentum. It's just buy, follow the rally, momentum. You've got people who've got money. Where are they going to invest?
But Facebook does have real profits. We should.
Yeah, they've got profits. I'm not taking that away from them. I'm just
Uber
saying.
doesn't. Some of the big ones that
Snap.
happened in the last. Yeah, Snap. Even Redfin.
Yeah.
That one went public.
Right.
There's no money
Zoom.
there. Yeah, there's no money in all those things.
No.
That's why I'm not interested. I'm just completely uninterested. I do not know where the interest is coming from. But here's what I think it is, Steve, and this is why we agree, I believe, on the macro situation. People tend to, the retail investor, which is who gets crushed in these crashes.
Yeah, unfortunately.
They tend to place bets, which is what buying a stock is in one context, on the stuff that they use and that they like. So people will buy stock in Tesla because they love the car. It's awesome.
That's losing money.
It's,
Only,
correct.
what, 700 a quarter?
Yeah, but it's, the stock price is $225, I think. So,
That's a buy.
Uber is one of those things. Lyft is one of those things. People are like, I know what that is. I use that all the time. So they think that it makes sense to invest in it. I'm just telling you, that's scary to me.
Well, I think it's worse than that, because I think there's a lot of, I think if you look at just the whole year marketing, okay, this whole stock exchange in America is the most marketed product just about that I know. Everyone's got to be in the market, or maybe you should be in bonds. But that's really, if you're a small-time investor, those are your two options. Maybe you own a house, right? And then after that, it's stocks and bonds. There's no other alternatives. None. So it's easy. It's nicely tailored. Yay, we'll make a little portfolio for you. Let's say I'm your money manager. You come to me and say, hey, Steve, I've got 100 grand. I go, cool. Derrick, how old are you? What did you say, 38 or something? Yeah. Okay, we'll do 70, 30. Wham, wham. 2 little clicks of my mouse. Boom. Okay, I get my $100 commission from you. See you later. Next. I mean, seriously, and I don't give a damn anymore because I'm done. I don't, because I've only made my $100 or $200. What am I going to spend more time on you? Right. There's no way. So the whole thing is tailored. So now then you get all of these little portfolios that behind the scenes in Schwab where they're now, oh, we don't charge anything. We charge 0 to manage your money. 0. How much time do they take? They've got some robo-trader that then just allocates based on age and supposed risk profile on that, and bam, in your, whoops, it's done in 30 seconds.
And that's something I definitely want to talk to you about. Let's see here. What's up, Andrew? We are live on Facebook right now. We are taking your comments. If you want to ask the great Steve Bick something, or myself. Andrew says investors always want to make money, and the puppet masters will always pull strings to make sure they make money going up or going down. Now is the time to take earnings and buy real assets. Yeah, I think there's something to be said for that. If you've got a long run, especially if you're nearing retirement age, let's say.
Did he say buy real assets?
Buy real assets, yeah, like real estate.
No, I would agree with that. I mean, that's really what I've done. I've got minimal in the stock market, and majority of things are either in businesses or in property.
Yeah. And that's why I think real estate could be, because this is going to be a different kind of correction than the last one we were in. The last one was caused by real estate. Do you have an opinion on the effect that what's going to happen here in the economy will have?
I really don't, to be honest. I have thought about that quite a lot. It's really interesting to see if this is going to be a financial crisis or whether it's just an overly hyped stock market that's just going to take a crater, right? And then we all know, based on what the president's pushing, they're going to lower rates right away, and they're going to start, pumping more money into the economy. And don't know what they're going to buy, what's left to buy, right? Which is another scary topic that we can discuss. But I do believe that ultimately they're all about trying to drive asset prices higher. At the moment, the stock market's taken really the majority of that gain, but I think that something like real estate could be a good spot to be in.
It seems to me like it would make sense.
Particularly if you're getting interest, if your loan is at negative rate.
The loan pays itself back.
That's right, exactly. Now you're talking stimulation. You might want to tweet that to Trump.
I mean, one thing that
seriously,
if you want to spend a whole bunch of money,
yeah,
just pay off all the student loans. Like if you really want to stimulate,
that would help.
There's $1 trillion of student loans. Just pay those all off.
Correct.
And then you immediately will see people increase their lifestyle. Because what you really need for the economy, and you and I both know the economy, quote unquote, is really just a giant Ponzi scheme.
Correct. You
have to keep putting money in order to get money out. It's not a situation where if people freeze up, the music stops and everything drops. And that's just kind of how it works. So
which is where we are.
And I think we're approaching that. I don't think we're there yet, because if you're looking, and want to show the screen real quick, Kara, this is Uber, by the way. We mentioned it earlier. I did want to give you the quote here. It closed at $39.95 today.
Yeah, there you go.
So it did open. It looked like it IPO'd at 45-ish or somewhere close.
And then straight down.
Got as low as $36. Makes sense. They're not making any money.
But then they should be at 0.
Well, you think so.
But it's a household name, and you would hope that they can clean it up. I mean, there have been certain companies that have come to market not making any. Amazon springs to mind, right? They didn't make money for a long time and finally managed to get themselves to profits.
They did, but Amazon is a different ball game.
It is completely, but I'm just saying there are these.
It does happen, but you can't count. If 83% of these IPOs
are all losing money,
I mean, you know what's coming.
I would think. Do you not have anything bigger in there?
I have this.
Well,
perhaps you prefer the gong.
There you go. But
so with regard, okay, so we touched on Trump real quick, on the things that he's done. Yeah, he definitely has a bully atmosphere to him. There's no doubt about it. That is what he has done in business. It has worked. He's taken that to the White House. I think some people like it, some people hate it, whatever. Some of the numbers do look good. Some of the jobs numbers look good. But here's the problem, Steve, and this is probably my biggest thing, is when the economy is good for a long enough period of time, it really doesn't matter that the economy is good anymore, that unemployment is good, because people will still outspend their means. So if things are going well, and whether you're a small business owner or whether you're a W-2, doesn't matter, when you have done well for many years, you'll start to stretch things out a little further. When you go to trade the car in, you get a little bit nicer car.
Right.
When you go to do those things or book a vacation, you book a little more expensive. When you put a little more on the credit cards, because you feel comfortable and confident that you will be able to pay those off. And that's the real concern, is that we've actually had such a good run for such a long time.
Yep.
At some point, we're going to get in our own way, because we always do, and the short-term credit cycle stuff is real. The defaults that are increasing on car payments, credit cards, auto loans, that's all real, that's happening.
Well, I
That's
think
what
what
really
you've also got is a situation with low interest rates, as we've had for, well, forever, as far as we can remember,
Very long time, almost 20 years.
Yeah, and possibly going lower. It's sort of, it becomes muted, the effect, but what it does do is forces a lot of people to try and find yield. And what I've found in some of my other investments I've done, which is in the property world, buying and selling mortgages, because there's a whole market out there that just, trades these mortgages.
Right.
Back 10, 15 years ago, you could quite easily find a mortgage you could buy at a discount and get a yield of about 12 to 15%.
No kidding.
Yeah. Now, I mean, that's just getting squashed. And some of the stuff that people are buying, when I look and say the prices they're paying, I'm like, are you insane? That you're overpaying again, back to your thing. So the investments are taking on more risk for less yield, and eventually you have to pay the piper in that stuff, just like these stock investments in these money-losing businesses.
So how are you playing this market here, Steve? I mean, obviously you think that there's some sort of capitulation that's going to...
I'd say you have to have that. I mean, if you just look at the economic standpoint of an Austrian economist, right, and I follow that sort of train of thought a little bit. What they're saying is you can add money like we've been doing and keep the pot growing like you've been saying, but at some point you have to keep accelerating that growth, because let's say I give you $1 right now, you might say, oh cool, yay, my wallet's up $1. If you've got $1 million in your wallet and I give you $1, it's like whatever, right? So now I need to give you probably $10,000 to make the same impact. And as the economy gets bigger and bigger, or the debt gets bigger and bigger, you have to add more and more money. I mean, you think back to 2000, Greenspan fixed it all with 20 billion. That's like a rounding error today. Seriously, 20 billion is all it took to fix the whole NASDAQ bubble. 20 billion. Now we've thrown 5 trillion recently, and this is like 10 years later, 18, so 15 years later, we had to throw 5 trillion at it, right? What do we have to throw at next time? 20 trillion? Just to get some kind of effect. And yes, unemployment is down, but I just read an analysis on the way over here. It was showing that the U.S. wage earner is earning less as a percentage than they have before we went into 2008. So we've recovered and we've got low unemployment, but they're not making any money.
Wow.
They're just not seeing the effects. And now around the globe, you've got all these governments are saying we're raising minimum wage. What that's doing is, it's supposed to, now we can all get paid more is the theory, right? I own a number of small businesses. It puts you on the brink of going out of business, because you can't keep paying people more and more. That means we have to keep raising the price of the products, and then people have to pay more for the products. No one wants to. And so a lot of these small businesses will go.
Well, that's an interesting point to bring up, because we're talking about the trade discussions with China.
Yeah.
Which I'm not super privy. I do follow the president on Twitter, because he'll just tell you what's going on. Like there's absolutely no filter there. Which is great, but you also don't know how much of it is posturing, because he knows the Chinese are looking at that, and he's a very good negotiator. So I expect that some of that is probably selectively dropped in there.
Right.
Like, we'll be fine, buy stuff from Taiwan. I started saying that the other day. There's other places, buy stuff from the US, we don't need China.
Right.
But the trouble is, people believe that, well, if we tax the Chinese goods, the stuff coming out of China, okay?
Yeah.
And it's coming in here, and it's a lot of the stuff. I mean, it's everything that's in Walmart right now. I mean, there's a lot of stuff that's coming from there. That people believe that, well, that stuff will the prices will go up, and that consumers will feel it. I believe that every company is already trying to maximize the sale price of whatever their product is.
Of course.
So they've already tried to figure out where is the top end that someone's going to pay for this. You can't just add money onto it.
Can't do it.
So if you can't do that,
Yep.
then you're either out of business,
Yep.
just over,
Gone.
that's it,
Yep.
or you have to figure something else out.
Correct. So what's done is you've taken the playing field and you've just tipped it right securely, firmly in big businesses' hands. They can get the loans, they can get access to the stock market and get the money from everyone there, and they can afford to pay a few people more and absorb a bit of price increases. What you've done is you've pretty much washed away the supposed engine of growth in America, which is small business, and that's the middle class people, and you've seen the big, huge shrinkage of middle class in America gone because they've just been pushed out. So people are forced now just to go get regular jobs. Yeah, we'll live the American dream. We'll go to school. We'll kill ourselves to get A's. We'll then go to university, kill ourselves to get A's there, so we can go and work for the man, have 1.5 wives, 3.75 cars, and 2.65 houses, and then die. Yay. Woo, sign me up. I mean, seriously, this is what they've created. To be an entrepreneur, when I came to this country back in 86 or 87, I remember starting a company with 20, 30 grand. The most recent companies I've started have cost me about $1.5 million each. It's
Wow.
insane, because the problem is you go in there and you've got all the legal stuff you got to deal with. You've got to suddenly, it's not quite as bad here, but in Hawaii you have to provide them with disability insurance, health insurance, workers' comp insurance. Then you've got the whole FICA and all of that. You've got to lump all that on. You've got to create a brand to be able to charge enough to handle the cost of your products and all of your labor and workers and all of that. It's crazy.
And how in the world are some of these companies like Uber, for example, raising all this money? How much did they raise? Tens of billions of dollars?
Yeah, I don't know how much, but a lot.
Where is that coming from?
Well, look at Tesla. That guy, and he's one of my countrymen, I'm ashamed to say, but anyway, he just stands up and says, we need money, and here it all comes in a wave. Where does the money come from is the next question.
That's what I'm asking. Who is providing this money?
That's the problem.
Because
I don't know.
Because the people providing that money are the people who are going to get taken to the cleaners.
Okay, now, the next thing I wanted to bring up was, we went back and we said 83% of IPOs are all losing money, the all-time high, right?
Yeah.
Not the high you want, but
No.
it is. Okay, and then, now the other thing is, so they come to market, excuse me, we come to market, and the reason they take it to market is you've got the fat cats that supposedly fund these startup companies and they want to get paid back,
Yeah,
right?
they wanna make
And
money.
you hear about how much money they all make, okay? And I read an article the other day that there's about $800 billion will be repatriated to the people that seeded all these companies. Okay, 800 billion sounds like a lot over the last decade. But they put in 650 billion. So the return is pretty minuscule. It's not really worth the
Doesn't
risk.
seem to be worth the risk.
No, which means a lot of that 650 went to zero, right? So some of them are home runs, but it still hasn't really offset the risks.
And what is the reality behind these things coming to IPO? Because I think that it's a very interesting situation to say, well, we're going to continue to just keep banging out these IPOs. There's some sort of conflict going on there between the market, let's call it Wall Street,
Correct.
and Main Street, where they're just saying we're just going to keep banging out IPOs because we think that these people will buy it.
Yeah.
There's no
Well,
responsibility.
look at your market.
There's no oversight.
Yeah. Look at the market. If it's at all-time highs, that's when you list, right? Now, the funny thing to me is the other thing that people don't get is that a lot of this returns that they're getting on these investments, so they take, they take a stock and you buy a stock based on the stock price to their sales or to their earnings. And the way that you can jerry-rig that is you just buy your own stock back as a company, right? Now there's less shares outstanding, so suddenly your
Buybacks,
earnings
yeah.
per share go up.
Yeah.
Well, that's been at an all-time high. Well, why has it been at an all-time high? Because these companies can borrow money for 1 or 2%. So if you're CEO of, Qualcomm or, Microsoft or whatever, why not just go and get a $10 billion loan at 1 or 2%, put out a bond there, bring the money in and spend the money, buy back the stock. Then the price of the stock goes up, and guess what? 80 or 90 to 100% of your income is based on the options you've been given as CEO. So you just want the stock to go up. So you don't care about the longevity of it. You just want to get the stock price up. The quickest way to do that is buy your stock back, increase the price, the value of the stock to the amount you're making, and there you go. Yay. Stock price goes up. You've got all of your options in the money.
Investors are happy.
Well, yeah, until you get to a point where you have to start refinancing this debt. And so there's trillions out there in terms of corporate debt just from this whole binge of buying their stock back.
Wow, interesting stuff. We are live here on Facebook. If you want to drop some questions, Andrew says, portfolio equity isn't real, gives you a false sense of confidence. The only real means is income. By the way, guys, this is great content, great stuff. Keep it up. Thank you, Andrew. Appreciate that. Yeah, it makes sense. Yeah, and that's my major concern about everything is that pretty much your wealth, I don't know about yours, but most people, mine, any wealth that you have, any money that you have is just a number on a computer screen.
Yes.
I mean, that's pretty much all it is. Or on an app or whatever.
Right.
You're looking at it, you feel like that's mine. That's mine right there.
Right.
But it's just a number on a screen. When that phone goes out, when the power goes out, you have nothing.
Exactly.
So it's a much more fragile situation than it sort of seems like. Maricela, how you doing? She says, I wonder if it's safer to invest in real estate outside of California. The San Diego housing market in particular has had a history of fluctuating strongly. The cost of real estate goes down, but rental rates are expensive and fantastic if you're a homeowner. We've talked about out-of-state real estate.
That's all I do. I don't have anything in California.
It just doesn't make sense from an investment standpoint.
No, as an investment, the way that I look at it is, so I go in and I buy the loan and I look at the property, right? So you want obviously some coverage there and you want a decent property. But outside of the country, particularly like in places, like Georgia and Tennessee and all these other states around the place, they don't see the capital appreciation we get in this state. I mean, you buy a house for 100 grand, 5 years later it's 110.
Right.
So you're not buying it for that, but what you do get on a 100 grand property outside of the state is you get a rental of about $1,000 a month.
Yeah.
So that's 10% return, right? Now I would normally buy that at a discount, so I'd be in it for 60 grand, get 1,000 rent. Now you're really making money. That's the way you look at it, but that's got some security to it. Where I think she's exactly right. Here in California, it's just craziness.
Yeah.
And then when you toss in the cost of the taxes, I mean, 1.25%. I was looking at maybe buying a place in Hawaii, and the property taxes there are 0.04%. So here you buy $1 million house, and you have to pay 12 grand in property tax. There you buy $1 million house, and you pay 4 grand in property tax. Big difference. That extra 8 grand a year can go towards paying down your mortgage or your principal, and you can get out of debt really quickly. And so, I mean, it's night and day. This place is crazy.
Yeah, especially for investment properties. I think she was talking about. Like, if you want to buy an investment property, California is a tough place to do it and have it make sense. People are doing it and doing well with it and have been for a while. I think it's harder though than it is.
But it takes a big dollar.
Yeah.
I mean, if you've let's say got $1 million to invest in real estate, you can get a portfolio of 10 or 15 properties outside of California, and New York and various other hubs, right? You can get a hub of 10 or 15. If one of them catches on fire and goes down, you're still okay. You've got 14 left. In California, you can maybe get 2. Now you're so focused on those 2 little properties. Something happens in one, you're in trouble.
Yeah, it is. It makes it more difficult. So you used to tell me about, and I want to talk about the election year that's coming up too, but you used to tell me that, I can't remember the guy's name, is it Nassim Taleb or something?
Taleb, yeah.
Taleb, who always bet against the market.
Yeah, crisis manager.
He would lose money every year the market did well, but then when the market would crash, he would make fortunes.
Yes.
Well, you still subscribe to that theory?
It's the only thing we can guarantee is the market will crash. It really is.
What define crash?
Well, down at least 20, 30, 40%. 20+% at least.
I think 20% is considered
That's
a crash.
A bear market, but
a bear market, yeah. 10% is a correction.
Exactly. So 20%. I mean, it's guaranteed. You can't just go up. They even, in the Bible, they try to build the Tower of Babel or whatever, and it crashed, right? Mankind's always tried to grow things to infinity and beyond, and it always crashes. It has to. It's the same with the stock market. It has to crash. So that's what they bet on, is the next crash. And they also say that you stair-step your way up the stock market ladder, but you come straight down in an escalator. So you make far more money on the downside than you do trying to pick winners on the upside.
What is he saying right now?
Oh, no, he's saying everything he's reading, it's looking bad.
Okay. And how are you playing that?
Well, I've got all of my puts in place. I've actually got a fair amount. If I'm long anything, I'm long gold. And I know people hate gold, can't eat it, can't whatever it is. I've heard all these things, But the funny thing is that gold has been a store of value since, forever. And it's holding its price around about $1,250, $1,300 an ounce. It's really
that still sounds expensive to me.
It's not really, if you look in terms of what the dollar, well, if you look in terms of a dollar, it might be, but in terms of the global way, if you take inflation, it's not really that expensive. And also if you take demand and supply, it's not really. The demand for gold is outstripped supply tremendously over the last 3 to 5 years. And the only reason the supply exists is because Americans hate gold. So they're selling all their gold. And the Chinese and the Russians and the Japanese and the Europeans are all buying the gold. Plus, there's a lot of gold being used in, your Apple iPhones and things like that.
Absolutely.
So there's a fair amount of usage as well. And the supply of gold coming into the market is slowing down. So they're finding it harder and harder to find good gold deposits. So at some point, you just get that simple supply-demand curve. And then I think when you have some kind of, not necessarily Armageddon, but when you have a stock market that rolls over and dies, people look for safety, and that is one of the reasons that
I've got the gold spider shares here on the screen, so you can kind of see that's the 1-year chart.
Now, interesting, that's
it's the 5-year right here.
Yeah, so it hasn't really done anything.
Which is interesting because the market's been straight up. So I don't.
But that's the stocks, right? These are stocks.
This is the spider that tracks the.
Okay, so if you take what they call the HUA index, it's the index of the price of gold to the value of the stocks and the value of the deposits on record, right? It's almost at the lowest ratio it's ever been, meaning that the gold miners themselves, which is that chart, are incredibly undervalued in comparison to the price of gold. They're just hated, literally hated.
Why?
I don't know. If you see these, and they're making money at $1,300 an ounce. As you say, gold, they can make money at that.
That's a nice number.
And they've spent the last 5-10 years cleaning up their balance sheets and making certain they got cash flow, and because they have no access to bank loans really, because the bank's sending all the money to these high-flying tech stocks. So the miners have really had to tighten their belts and make certain they're operating proper businesses with proper cash flows, with good margins, and they've just been beaten into submission. I mean, down 80-90%. It's like, it really
is that a buying opportunity?
I have been buying, but I look at the chart. But then it's just, for me, it's sort of helps when you see a day like 2 days ago when the market sold off, and I'm up 6-7% just because all my gold stocks start rallying, all the price of gold rallies. You've got all my puts start working.
I'm worried about that correlation hanging in there, but I guess most of the money that's in the market probably is being held by an older generation that still believes that. I think that the next generation doesn't have that thought about gold. They won't move their money to gold.
Maybe not.
We'll be old men by then.
I'm not planning on holding this thing forever. I've never held anything forever. But yeah, I agree. I mean, Bitcoin bust out yesterday.
Did it?
Yeah, it was hovering around 4,000 or 5,000 forever, and then it slowly moved like 5.5, 6.5, and then I just saw it bam to 8,000.
Wow.
So there's your youngsters playing it.
I was going to say,
maybe.
what is that?
Yeah. Well, there's a
What
number.
is that?
At least I've got a piece of gold I can hold.
They can hit you with it.
Don't throw your laptop in the river because all of your Bitcoin is gone instantly. There's a guy that apparently did that, right?
Really?
He had all of his Bitcoin numbers, serial numbers, were on an external drive, and he thought he had transferred them all over, and so he threw that old drive away, and the dumpster came and took it, and he was like $20 million worth of Bitcoin went to the dump, gone forever.
My goodness.
Yeah. So that's the security of Bitcoin, right? You can have all these blockchains, but if you lose your hard drive, you're in trouble because you've got all the numbers. You've got to store them.
Oh, I know. I've got Ripple. That's all I have.
Have you got Bitcoin?
I have Ripple.
You got who?
Ripple.
Oh, but you don't have the actual. Oh, you've got the Ripple numbers.
Yes.
Oh, I see. Okay, so you could buy and sell things with that.
I could.
Oh, okay. Well, very nice.
Out of my Coinbase, yeah, on my phone. I could buy it if I wanted to, but it's
you could fund some terrorist group.
You could. You could.
That's the problem with those, isn't
Well, there's
it?
a lot of problems with those.
And
as far
it's
as
too
crime is
volatile,
concerned.
right?
It's very volatile, but it's, I bought the Ripple because I thought it was the best of the cryptos. Hey, I'm going to play some crypto here, so I got into Ripple. It's down a ton. I don't look at it.
It might be up now.
It probably is a little bit, but I'm sure I'm still down overall. And what I'm trying to really figure out, Stephen, what I'd love to help sort of guide through here with you, because I know about your put strategy, and I want to talk about the election in next year specifically, because there's some pretty big predictions going, is how do we make money on the downside of this thing?
On the market.
Yeah, because you've got puts.
Yeah.
There's a lot of, ultra short ETFs, things like that. Like, are there things for people who might be watching this and might be saying, hey, I want to make money when the market goes down too. What are things they should not do versus maybe should try from
though, and it doesn't seem like you're making money, but the easiest way and the safest way is just go to cash, because it doesn't feel like you're doing very well, but when the market goes down 30-40% and you're still at 100%. Plus, to give you a great example, when the market rolled over back in 08-09, I had a friend that was in cash, and he didn't have a lot. He had 200,000, which isn't a little, but it's not, an absolute fortune.
Yeah.
And it got down to around about 700, the S&P. And he said to his wife, either this is going to be zero, where the whole world's just blown up, or this is just insanity. So he put his money to work because it was just so low. And of course we know 667 was the low. So he literally got lucky, and that turned that 200, when it recovered a little bit in a year or 18 months later, turned that 200 into $1 million, right? And then he looked around and he said, these properties around are just being given away. So he took the $1 million and bought like half of Vista. And now that's worth $6 million now today, and making him $20,000 a month in income. So I think that's that power of cash, right? You don't have to be a genius to time some of these things. You just have to have your rational wits about you. And it's hard to be rational when you long the stock market and it's falling to pieces and you're just praying that it's going to go the other way, right? That's not rational. Or, the other thing, when I was doing a lot of trading and the psychology of trading, if you're trading, like you and I are sitting, we're relaxed, we're sitting here on this nice comfy couch. During the day as you trade, you find that you're sort of leaning forward and eventually you're like this and you're trading all hunched up. You're not trading rationally. And believe you me, it's funny, but there were times during like my first real big crash was back in 87, back there. And I was like this, and now, then you have to like, jeepers, breathe, sit back. You're not trading rationally anymore. And so if you are in cash, it's much easier for you to look and go, wow, the market's coming down. Oh, look, it's going down more. You don't have to buy the bottom, even if you miss the first 5-10% of the recovery. At least if it's sort of a washout, you'll be able to pick it up relatively easy. So that's one way. I don't think people need to, but the problem is everyone listens to the neighbors on, I've made this and I've made that, particularly in one of these false rallies we've just had. So that's one way. The other way, as you say, is to buy the puts in the market, or you can go and do the ETFs that are, triple X or whatever against the market. The problem with those is there's a lot of slippage involved in that. So while you expect to get that 3 times or 1 time, even just 1 time, it doesn't actually happen.
It doesn't add up all the way.
No, because they've got, transaction costs, and they've got to buy and sell things at the right times. And so there's tremendous slippage in those types of things. So you don't get the full Monty, but you at least get some.
And there's
benefit.
decay too, because they eventually all are set to go to zero, basically.
I know. It's like the best put. You just put a buy puts on all of these ETFs. That's why I'm not enamored with ETFs overall. I think it's a simple way to invest, but I think the thing we haven't really seen is when you get a big sell-off in the market, people are now just selling the SPY or selling, the QQQs or whatever it is, which is suddenly got 500 stocks behind there. So when you hit sell, they've got to sell some minuscule portion of 500 stocks, right? Well, when you multiply that by hundreds of billions of dollars, it doesn't matter what stock's out there, value, no value, everything just gets sold off.
Yeah, and it just doesn't, it can't add up exactly.
No.
What do you think about the VIX or playing like the TVIX or something like that?
Yeah, that's another way to go.
Because will it be, the question.
That'll be volatile.
It will be volatile.
Because
right?
Here's what happens with the VIX is it'll shoot up, right? And it'll slowly start deteriorating, and then it'll shoot up. So I think that's a trading sort of strategy versus I'm just going to buy and hold and walk away. You can buy a longer term put on it, which you and I were discussing before the show, and that comes with quite an expensive premium. But you could buy, say, a 1 or 2 year put. And then what you've got is you've got 2 years where you can sit on that position and just wait.
Let's take a look at that TVIX here. So there's that's the 5-year of the TVIX. So just to give you an idea of how it does approach zero.
That is funny.
Okay, that's the 5-year.
Yeah, we might want to zoom in.
We'll pull the 2-year here, so you get a little bit of an idea. It does approach zero. That's the trouble with it.
Problem.
But here's the 1-year. And so what you can kind of see is it did spike up to 80. So like for this thing, this is an interesting one because you can, if you buy at one of these lower areas, and we're at an area here right now where it's kind of the lowest it's been
it's
in a
really
long time.
low.
It's really low. So if you buy there, then you put like a sell order in at 60
But even
or
when
something.
you look at that chart, you can see just how it sort of goes to nothing. So it's a short-term trading strategy. The thing I don't like about that is you need to time that pretty close to right. Because if you'd bought that and you'd held it for the last 6-8 months, it's going to have one huge spike just to recover.
There's nowhere you could have bought this in the last 6 months and be up unless you just so happen to get in this little window here.
What about is that a year chart you have up there?
That's a 6-month chart. So 6-month chart, that's where it is right now, okay,
Yeah.
at the horizontal crosshair. So only those couple spots there below, which is right where I told you I was going to pull the trigger on it. I was looking to buy it at 20 and it just missed it. And the next day it was at 26 and it was just
but then you see that's the thing with this strategy, you'd better get out because it could be back to 18.
Could be. It could be. And it hit 30 intraday. And that's why I say I think with the TVIX, something like this is it's hard to really time it, but you buy it with an amount that you're okay with losing because let's be honest, the security's it's approaching zero. If you're right and you get the volatility, you might get a spike, but unless you're at the computer, you have to have the sell order in.
Agreed.
You have to have it in. So like this spiked up to 30. So the day I was going to buy it for 18, if I had a sell order in at 30, it would have filled.
Yeah.
But I would have had to have all that just right.
I know.
So it's
That's
a tough
why
one.
I don't trade that, to be honest. And the other side of trying to make money on the downside is, which you've touched on, you've got to be at your computer, and you also just really have to have, nerves of steel, because you'll get these rallies. I've been short the market for quite a long time, and you make a ton, and then it sort of gets stripped away from you pretty quickly, and then you make it back, and then you make it back. And I remember back in 2008-9 when the whole thing was just cratering, and I managed to earn 0.25% that year. I fought the market so hard to make that 0.25%. I got to about November and I thought we must be near the bottom. And of course March was the bottom, so I was 5 months too early. So I took my shorts off, right, my protection off, and 2 weeks later I was down 8%. Bam. I mean, all that hard work. I'd worked the whole year to be sort of even, and in 2 weeks I was down 8, and I went double the shorts, and I gained it all back in the next 2 or 3 weeks, and then I've leveled them out and end of the year up 0.25%. But I mean, that's
Wow.
hairy stuff. You really are fighting every inch of the way.
Yeah, it's tough.
Because remember, you've got the Fed fighting against you, you've got Trump fighting against you. Everyone wants the market to go up, right? His political career is sort of riding on the stock market at this stage.
Well,
from what I can
that's
see.
one thing that's also a consideration because he has been saying, "Hey, the stock market's up. This is mine. I did
Yeah.
this."
And so, yeah, good economy will keep the president in power normally, right? So he's touting this. And that's why he's playing all these silly shenanigans with the Chinese. Look, we're almost there. We've almost got a trade deal announced. The market goes, whoop. And then he goes, oh, no, I'm slapping on 20% more tariffs. And then, whoop, we go down. And he goes, oh, no, but we had a good negotiations today. Whoop, up we go again. I mean, it's the manipulation is insane.
That's crazy.
And now he's also talking about he wants, today I read, that he wants the Fed to lower rates to support these trade tariffs. So he's trying anything he can to keep this market up for the next 12 months. So the point of the matter is when you short the market, you know, the Fed will lower rates and the market will rally. Trump will say something and the market will rally. You really have to have belief in the underlying deterioration of the fundamentals ultimately taking hold and driving the market down for specific data-driven reasons, not for all of the rhetoric that's around there. And that's why I'm short.
And if you take a look here, this is the 5-day on the Dow, so you can kind of see there's been some volatility overall up. It kind of looks like a little bit of a topping out there. Makes sense, I think, why we saw this go down here.
Well, interesting. The thing that I always enjoy is if you look at that and you look at the volume at the bottom there, you see on the up days or the up bars, when the market's going up, the volume's the lowest. And when the market's coming down, the volume spikes. That's not what you want to see. That's not a solid bull market.
Unless you're short.
Yeah, exactly.
Then that's exactly what you want to see.
Yeah, that's what you're seeing because it's like, you know, this is a small group of stocks that's driving the market higher. It's not really based on fundamentals. It's just trading and being manipulated. So yeah, that's exactly right.
So being in cash, I do want to touch on that because there are some good money markets. Like you can get into these little money markets that'll pay like 1% or change. And the nice thing about those is that you'll get your money every month and it'll compound. So that's really nice. So those actually play out a lot better than it seems when you do the math because of the compounding effect that goes on there. So it's not as bad as it may seem. And having cash is really nice.
Right.
I was in cash, you know, in the 2008 crash. It was actually 2009 when we were at the very bottom there. I wasn't able to pull the trigger until we were up to like almost 8,000. I'll start buying stocks again,
right?
Because I was so traumatized by the downside.
Who wasn't?
I didn't have the stones, man. I just didn't. I kept waiting for another.
Well, I was
terrible
trading
down day.
only stocks back then, so that was my daily job. So I had to be. I mean,
you had to be. Yeah, you had to be in
in
there. You had to be in there. Now, 2020, we have an election coming next year.
Yes.
There's been a lot of predictions of a recession based on short-term credit cycle, the election itself. Is that going to be the catalyst here? And do the charts always need some sort of real-life catalyst to help unroll the vision, if you will?
What do you mean exactly?
So, like you know, when we see the technicals, you look at it and you go, oh, okay, well, this should go down.
Yeah.
But then there's always seems to be an event or something that actually, you know, causes it, or maybe it's just, hey, the technicals show us which way the wind's blowing, and then if an event happens to go with the wind, then it's just going to catch it on fire.
Well, I think the technicals, yeah, I mean, I see what you're saying. The data is already there to support a technical, you know, meltdown. So that's what I've been saying to you. The stocks have been driven by your FANGs and by the SOX. So we strip out all of that, the market's actually down big this year. Instead of being up the 18-20%.
Really?
Yeah. I mean, you take all of those guys out, the market is in the tank. So I think what the world has got to try and work out is there the second half recovery once they discover that there's not? In fact, on the semiconductor index, the forecast was for 3% growth. And 4 months later, so when they came out in April to adjust their growth, they changed it to down 7%. It's the biggest movement in their forecast that they've had since 2009.
Wow.
So you're getting these forecasters going, hey, there is no market, right?
Wow.
So now it's just a matter of when does the stock market wake up to this fact?
Well, I think if you look, and here we have, as we pulled up the 1 year, and you can kind of see, this is really suspicious to me, Steve, here. As you see in December, we saw this capitulation here. There was a lot of profit in that year, and maybe we lost it. I don't remember if the Dow ended up or down.
Was it down a little, I think?
Down a little for the year.
Yeah.
But there was, until that move, starting December, at 25,000, there was a lot of profit. That profit got taken out of the market, right? We got stripped out.
Yeah.
But then at the beginning of the year, right away, we're back in buy mode.
Yeah,
So
well, you're up 19% at one point.
So it really looks like, I mean, this looks like such a setup. I mean, if you just look at what days this thing started, and then boom, right here in the first day, whoo, we're off to the races.
Right.
It seems like the market makers are all still in agreement about which direction they're going to point their gun, right? And that they're pointing higher right now. When do they? Yeah, when they're trying. Clearly,
They are trying.
Clearly, you can see it. I mean,
I know.
it's right there. So, but that said, when are they going to turn on it? That's the question. When are they going to turn those guns and go, you know what? Flip it around, sell the long positions, and then go short. And that's 2 sales. I mean, that's a flip-flop, right?
Yeah.
And go the other direction. When is that going to happen?
I think it looks like it's already started, but I mean, this little move down, you can't ever put too much money on that.
No, it's hard. It's hard to do. It's hard to do. I mean, and the other thing too, I think going back to the TVIX. I know someone's asking the question. Or Andrew asked a question about the VIX. Let me see. Oh, really? Thank you, Adobe. That's awesome. Just awesome. Thanks, Adobe. Look at all that. Okay. So for the TVIX, for strategy for someone,
you can read those things on the screen.
I can see it better on that one.
Oh, wow.
But
Okay.
so Andrew says long the VIX. So if you're going to be long the VIX, here's a suggestion, and tell me what you think about this, Steve. And I know I've taken a lot of your time, and we'll wrap up here in just a second.
No
But
problem.
if you're going to buy into something like that,
Yeah.
have a plan in place that makes sense. So for example, if you say, okay, well, hey, I'm going to buy 2,000 shares of this TVIX.
Yeah.
Maybe set that first price target at a double for half of your shares or something
Yeah.
like that. So you can try to, take your cost basis out of there on a spike, and then you can really play with it.
Correct.
Then you don't have to stare at it. Then you can go, you know what? If this thing goes to hell in a handbasket, I've got free shares that I can cash out at any point in time.
Yeah, and remember though that in all bear markets, it doesn't go straight down, right? I mean, that December chart shows that it went pretty down, pretty much straight down for a month. But then we've had this big rally. And the similar thing is going to happen with your VIX. When you have these rallies, even if they last 2 or 3 weeks, the VIX price drops like a stone.
Yeah.
So that's why you really have to take that profit and then maybe look to enter at a lower price if you still believe we're not at the bottom. But that's, once again, we're back to trading, right?
Yeah.
You're back to in front of your screen.
You're back in front of the computer. That's hard.
Doubled over.
Well, that's why I like, hey, buy it. Okay, hey, you bought it at 20. Put in a sell order for half your position at 40. If it spikes up and hits it, then you're clear now.
Yeah.
You got your money back.
That's right.
And you have a free hedge.
That's what you do with options as well. So, for example, if you're buying a lot of options and something happens and it just gets pounded, then you take half them off and you ride what's sort of freebies because you've taken the cost of your options out, and now you're just riding your freebies for wherever they go. It's a lot easier and way to be rational, because in this type of market, it's really easy to lose that sense of rationality.
Which is the most important thing.
Yeah, calm and collected.
Steve Bick, thank you so much for coming on, man. It's great to see you.
Oh, yeah, it was
It's been
fun.
too long.
Yeah, that
You're
was a
awesome.
good time.
I appreciate your time.
Thanks very much.
Hey, if you guys want to make your friends smarter than everyone else, share this video, and we can guarantee that for them. See you soon. Boom.